We told you earlier about the $1.9 billion takeover today for Blackmores, which follows hot on the heels of a clutch of other takeovers for InvoCare, Oz Minerals, Newcrest, Origin Energy, the Bank of Queensland and Liontown. They're just some of them. So why is this happening here in Australia right now? And what does it say about the opportunities in our markets? JB Wiz, Chief Investment Officer, is Sally Old. And Sally joins me now. Sally, in a world that's sort of teetering as to whether it's going into recession or not, there seem to be people who are finding opportunities here in Australia. Why are they finding those opportunities here? What are they searching for?
So, Ross, I think there are two things that are going on that are quite interesting at the moment for Australia. So the first one is the currency. And now, obviously, the currency is sitting around 66 cents today, give or take, but generally speaking, it's sort of hovering around in the mid-60s. My sense is from observing these things, for a number of decades now, that I actually think that global long-term capital sees Australian assets as very cheap when the Aussie dollar is sitting in the mid-60s. So for those M&A transactions that are involving a buyer from offshore, I think that's actually a big part of the story, that these assets look cheap.
And there's irony there, isn't it? Because as the Reserve Bank becomes the first central bank in the Western world to keep interest rates on hold, and as our interest rates are much lower than other parts of the Western world, that simply means our dollar is lower, which, as you point out, makes Australian assets relatively cheaper.
Yeah, exactly. So I think that's one thing that's going on. And then the second thing that I think is a real differentiator between Australia and pretty much every other developed economy is simply population growth. So when we look at the numbers for the first 3 months of 2023, they basically tell us that population growth is running almost at 2.5% annualised, which is really, really high when you look at a history of net migration population growth. And so basically what that means is that's a huge support to what we would call any sort of real asset. So anything like property, like infrastructure, like the equity in a company as well. And so again, I think maybe offshore investors are looking at Australia saying, look, this is an economy that's probably going to outperform pretty much any other developed economy, in large part just simply because population growth is so strong in that country, and that's a pretty attractive support for a lot of financial assets. So,
and of course that migration story becomes really important in terms of the review that's coming out today. Claire O'Neill addressed that. We spoke about that earlier. But one other aspect of that is you make the observation about relative to other parts of the world. We might feel as though things are going to get a bit tougher. The economy is forecast to slow, but nowhere near as, say, the United States, Europe or the UK right now. And so they would look at Australia and say, well, it might slow, but it's not going into recession like our economies are. This is all part of the story as to why assets in Australia are relatively, shall I say, attractive to them.
Yeah, so I think so. So I think definitely the short-term, more cyclical outlook is better in the sense that, the market's not expecting a recession here, whereas now the consensus thinks that's basically a lay-down misere in the US, perhaps other countries as well. But also, population growth is a really important driver of your longer run GDP growth. And when you think about these companies making acquisitions, we assume that they're looking to invest for the long run. And so not only do they care about the sort of short-term ups and downs in the economy, but they also care about the longer term prospects. And with population growth sort of 2.5%, I think that's a pretty solid anchor for strong economic growth and hence an attractive place to deploy capital.
And the reality is, if you've got more than 350 million people, as the US does, if you've got, say, 1.3 billion people, as China has, if you've got more than 100 million people, as Japan has, it's hard to populate your way out of an economic problem. Australia, having a relatively small population, has got the luxury of being able to almost populate its way out of a problem if it has one.
We do, although as we're finding out in the short term, there are positives and negatives to this story. And one of the positives that businesses like is that it's a new source of labour supply. So we hear often from businesses that it's really hard to find labour, the labour market's really tight, having to pay up to get good workers. Increased net migration is one way of solving that, but we also know it puts pressure on other parts of the economy. And I think right now, probably that pressure is most acute in the housing sector, where pretty much in every capital city in Australia, there's an undersupply of housing. Population growth is strong, rents are going up. And so that does present some shorter term challenges, I think, for governments to manage.
OK, so we've looked at this from an overseas perspective, looking into Australia, then bring it back to Australia. Of course, you don't get the attraction of looking around the world right now with the cheap Australian dollar to look for discounted assets. You've got to look back here at home. The question is whether there are discounted assets here in Australia that even look attractive for the local people here.
There's always opportunities in markets, and I think for us at JB Weir, one of the biggest ones that we see at the moment is actually in the fixed income market. And so, one of the things that's happened over the last couple of years, as we know, is central banks have lifted rates a long way in a very short space of time, and that has basically repriced the whole fixed income universe. So the yields on government bonds, the yields on corporate debt have all gone up a lot. And so for many of our clients, this is almost like a new asset class to play in, because we only have to go back a couple of years where cash rates were basically zero in most parts of the world. And so the risk-return characteristics of that asset class were just really not that attractive. Now that's basically flipped on its head, and you can earn, I think, what are relatively attractive yields for a lot of investors for a much lower level of risk. And so we're seeing many of our clients looking to deploy capital out of other asset classes into fixed income. And at the same time, we still think that within the equity market complex, because the economic environment is a little bit uncertain, now is not the time to be sort of deploying capital into the more speculative part of the market. I think you really want to sort of anchor your portfolio with a portfolio of stocks that are quality. So
that are producing cash, right?
That's right. They don't have a lot of leverage on the balance sheet. They have a proven ability to manage through the cycle, so they're there in good times. They can generate profit in bad times. They have a relatively sort of protectable margin. They're the sort of companies that I think are worth owning at the moment.
And JB Weir has certainly had that, shall I say, mantra for investing for a very long time as well. Sally Old, Chief Investment Officer, many thanks for your time today.
Thank you, Ross.